Hello, I'm Nuale Graham from ARM Investment Managers, and I'll be walking you through the key financial market highlights for February 2024. For the domestic macroeconomic update, Nigeria's GDP grew by 3.46% in Q4 of 2023. This is an improvement from the 2.54% that was recorded in Q3 of 2023. This was largely driven by growth in the oil sector, which grew by 11.26%, and the non-oil sector, which grew by 0.32% in the last quarter. Overall, the Nigerian economy grew by 2.74% in 2023 fiscal year when compared to 3.10% that was recorded in 2022 fiscal year. The Nigerian Bureau of Statistics reported that in January 2024, headline inflation rose to 29.90% from 28.92% that was recorded in December. Food inflation increased to 35.41% in January compared to the 33.93% that was recorded in December. And core inflation reached 23.59%. On a month-on-month basis, headline inflation rate stood at 2.64%, indicating a 0.35% increase from December's 2023's rate of 2.29%. The key contributors were food, housing, and clothing. Over a 12-month period, the Consumer Price Index averaged 25.35%, showing a 5.99% increase when compared to the 19.36% that was recorded in January 2023. Moving on to the financial markets update, the Central Bank of Nigeria conducted its first Monetary Policy Committee meeting for the year on the 26th and 27th of February. The key highlights from the meeting are 1. Increase in the monetary policy rate to 22.75% from 18.75%. Secondly, the Central Bank of Nigeria raised the asymmetric corridor to positive 100 and negative 700 basis points around the monetary policy rate. The lending rate is currently 23.75%, while the deposit rate is 15.75%. There was also an increase in the credit reserve ratio to 45%, and the liquidity ratio was retained at 30%. In the equities market, in February 2024, the Nigeria stock market ended its fourth-month winning streak, closing bearishly when compared to the previous month. The NGX All-Share Index lost a negative 1.16% in the month to close at 99,980.30 points versus the 101,154.13 points recorded in January 2024. This was attributed to the prevailing high fixed income yield environment, which saw an average yield increase of 5.24%. Overall, the market experienced a decline of negative 5.39%, resulting in a year-to-date performance of 31.76% versus the 35.28% in January. Additionally, the year-to-date performance of the NGX 30 index stood at 33.54%, marking a notable decrease from the 40.88% recorded in January 2024. On a sectoral basis, the consumer goods increased 16.44% in the month, and the oil and gas sector increased 4.14% in the month, while the declining sectors were the industrial goods losing 13.33% in the month, the insurance sector losing 6.08% in the month, and lastly the banking sector losing 2.01% in the month. Top gainers were Boa Foods gaining 39.77% in the month, Geregu gaining 90.23% in the month, Airtel Africa gaining 10% in the month, and Seplat gaining 9.61% in the month. The top declining stocks were MTN losing 24.16% in the month, Dagsem losing negative 10% in the month, Boa Cement losing 18.92% in the month, and Access Corp losing 24.01% in the month. Moving on to the fixed income market. In February, the Nigerian fixed income market experienced a significant increase in yield. The average yield in the FGN bond market surged by 2.73% month-on-month closing at 17.22%, while the average yield in the Nigerian Treasury bills market increased significantly by 7.75% in the month to settle at 16.90%. Overall, the Naira fixed income market experienced a 5.24% month-on-month increase, closing at 17.06%. This upsurge was driven by investors' anticipation of a rate hike by the Central Bank of Nigeria to curb inflation and manage liquidity. In February, the Debt Management Office removed the maturities of 2027, 2028, 2029, and 2033 from the bond calendar, replacing them with two new bonds, the February 2031, which is a 7-year bond, and the February 2034, which is a 10-year bond instrument. Each bond was offered at a value of 1.25 billion naira, with respective stop rates of 18.5% and 19%. The secondary bond market experienced negative sentiment in February, with average yields rising by 2.73% in a month to close at 17.22%. This upward trend was driven by sell-offs across different maturities as market participants adjusted their positions in anticipation of higher yields. Notably, sell-offs occurred in all 4 weeks of the month, with yields increasing steadily each week. The Nigerian Treasury bills market was bearish for most parts of the month as market players sold down their position in anticipation of higher yields in the near term. During the month, the Debt Management Office conducted 2 auctions offering a total of 1.27 trillion naira, which was significantly higher by 981.62 billion naira when compared to January. The total sales amounted to 2.6 trillion naira, indicating an 8.02% increase when compared to the 288.38 billion naira sold in January. At the Nigerian Treasury bill auctions held during the month, average stop rates increased by 11.5% in the month to settle at 17.96%, while the Nigerian Treasury bill's secondary market average yield increased by 7.75% to settle at 16.9% in the month. So the outlook and strategy, starting with the equities market. Following the recent increase in the monetary policy rate to 22.75%, we expect a redirection of investors' interest from the equities market towards the fixed income market. This shift will likely be motivated by the desire for higher yields as a hedge against inflation. However, this scenario could also create advantageous opportunities for investors to enter the market at reduced prices, especially in high dividend-paying stocks, as the earning results for the 2023 fiscal year are disclosed. In terms of equity strategy, we advise investors to strategically invest in stocks from sectors showing strong fundamentals, especially in banking, industrial, and the oil and gas sectors. For the fixed income market, we expect bearish sentiment in the Nigerian fixed income market to persist in the short to medium term due to the central bank's aim to tame inflationary pressures and tighten liquidity in the system. Given this stance, we expect higher short-term yields to persist. Thank you for your attention. We appreciate your time and engagement. If you have any further questions or inquiry, please do not hesitate to contact your relationship managers and our customer care representatives. Remember, we remain invested in your tomorrow. Until next time.